I am the grand archivist of economic history, keeper of the chronicles of what was and what might have been. Today, I open the forbidden volume, the record of the timeline where gold remained sovereign over paper, where the anchor never broke free from the harbor, where humanity chose the certainty of precious metal over the promise of progress. On August 15, 1971, history diverged at its most critical juncture. In our timeline, Nixon closed the gold window, freeing money from its golden cage. But what if he had chosen differently? What if the dollar had remained convertible at $35 per ounce? What if the world had accepted deflation instead of liberation? This is the chronicle of that grim path, a 50-year journey through monetary purgatory, where every economic growth was balanced against the zero-sum weight of gold, where innovation was shackled to stability, where the future served the past. Chapter 1, Day 0, August 15, 1971. The moment that wasn't. The president's hand trembles as he reads the telegram from Paris. President Pompidou has announced his intention to convert $3 billion in dollar holdings into gold. The Bank of England has already requested $800 million in gold the previous day. At $35 per ounce, this represents 22,000 pounds of precious metal, more than the United States mined in the entire year of 1970. Treasury Secretary John Connolly's words echo in the dim room. Mr. President, our gold reserves total $10 billion. Foreign dollar claims exceed $50 billion. At current rates, we have perhaps 60 days before complete depletion. But in this timeline, Nixon makes a different choice. Instead of closing the window, he orders the Federal Reserve to act. At 3:15 a.m., he drafts a different speech, one that will bind America to its golden chains for another half-century. Tonight, his revised address begins. I announce the Gold Protection Act of 1971. The United States will maintain full convertibility at $35 per ounce. To preserve this commitment, I am authorizing immediate import surcharges of 15% and implementing domestic wage and price controls. We will endure the necessary pain to preserve the stability that has served us since Bretton Woods. The Federal Reserve immediately raises the federal funds rate to 8.5%, Burns announces. We will defend the dollar's gold parity through monetary contraction. The money supply will be reduced by 5% over the next 12 months. Inflation at 5.4% will be crushed through fiscal discipline and gold convertibility. Full employment is secondary to monetary integrity. The first casualties emerge within hours. General Motors announces layoffs of 75,000 workers as higher interest rates make auto loans prohibitive. The unemployment rate, already at 6%, begins its ascent toward 8%. Housing starts plummet 35% as mortgage rates exceed 10%. But the gold window remains open, at a terrible cost. By September 30, 1971, U.S. gold reserves have fallen to $7.8 billion. Foreign central banks hold $45 billion in dollar claims. The arithmetic is merciless. Each ounce of American gold backs $5 in circulation. The Federal Reserve imposes capital controls reminiscent of wartime, requiring export licenses for gold and limiting foreign purchases to $100 million per month. The dollar's overvaluation, now officially sanctified through Nixon's refusal to devalue, turns America's trade deficit into a hemorrhage. Imports surge 25% as foreign goods become artificially cheap, while exports collapse. Factories close across the Midwest, but gold flows outward, a metallic tribute to the world's remaining superpower. This is Day 0, the moment when history chose the path of metallic orthodoxy over the promise of monetary freedom. The consequences would unfold across 5 decades of constrained growth, persistent deflation, and the slow suffocation of economic dynamism. Chapter 2, 1970–1980. The Deflation Decade. In the alternate timeline, The 1970s are not the decade of great inflation, but the era of great deflation. Without the ability to expand the money supply beyond gold reserves, the Federal Reserve becomes the enforcer of monetary austerity. Each dollar in circulation must be backed by 0.286 ounces of gold, the immutable law of metallic money. The numbers tell a story of systematic decline. GDP growth averages 0.8% annually from 1970 to 1980, compared to 3.2% in our timeline. The unemployment rate peaks at 14.2% in February 1975, as the Fed maintains interest rates above 12% to prevent further gold outflows. Business investment collapses, not from lack of capital, but from the scarcity of money itself. In Cleveland, the foreclosure rate reaches 8% by 1976. Mortgage money is simply unavailable at affordable rates. The 30-year fixed mortgage rate stabilizes around 15% as banks hoard deposits against the possibility of gold outflows. Home prices fall 30% nationwide between 1972 and 1978, a deflationary spiral that becomes self-reinforcing as falling collateral values force more liquidations. The oil crisis of 1973 hits with particular severity. In our timeline, OPEC's price increases fueled inflation that helped erode debt burdens. In the gold standard timeline, higher oil prices represent pure deflationary pressure. American consumers, their wages frozen by Nixon's extended wage controls, cannot afford $4 per barrel oil. Gasoline lines stretch for blocks as stations ration fuel to prevent hoarding. Japan's economic miracle accelerates. Toyota's market share in the United States doubles between 1972 and 1978 as American cars become prohibitively expensive abroad. The dollar's fixed exchange rate, maintained at $35 per ounce of gold, creates massive competitive disadvantages. American steel production falls 35% as foreign competitors undercut domestic prices by 40–50%. In Washington, the political consequences mount. The 1974 midterm elections deliver a 50-seat Republican loss as unemployment ravages industrial states. Senator William Proxmire, chair of the Senate Banking Committee, demands hearings on the gold standard suicide pact. The Fed's Burns testifies that abandoning convertibility would invite the inflationary chaos of the 1920s Weimar Republic. The comparison is not hyperbole, merely historical amnesia about deflationary chaos. The cruelest irony of the gold standard: money becomes more valuable while people become poorer. The purchasing power of the dollar increases 25% between 1971 and 1980 as prices fall across most sectors. But this monetary appreciation is achieved through the destruction of earning power. Real wages fall 12% over the decade as employers, unable to access credit for expansion, freeze salaries and cut benefits. By 1979, the situation approaches catastrophe. Gold reserves have dwindled to $5.2 billion, representing approximately 150 million ounces. Foreign dollar claims remain at $35 billion, creating a 7:1 ratio of claims to metal. President Carter, facing re-election, considers the unthinkable, suspending gold convertibility. But the Federal Reserve, now dominated by gold standard ideologues, threatens mass resignation if he abandons the $35 parity. The decade ends with America fundamentally transformed. The industrial heartland has become the Rust Belt. Unemployment insurance claims exceed anything seen since the 1930s. The social contract between employers and employees, already strained, begins to unravel. Gold continues its slow migration from American vaults to foreign central banks, each ounce representing the transfer of economic sovereignty from Washington to the capitals of rising economic powers. Chapter 3, 1981–1990. The gold constraint deepens. President Reagan faces an impossible dilemma. His campaign promises of tax cuts and military expansion collide with the iron law of gold convertibility. Each proposed tax reduction must be balanced against the certainty of reduced revenue at a time when gold outflows continue unabated. The Federal Reserve, still dominated by gold standard true believers, refuses to accommodate any fiscal expansion that might accelerate the depletion of reserves. The numbers reveal the crushing constraints. By 1982, U.S. gold reserves have fallen to $4.2 billion, approximately 120 million ounces at the fixed $35 price. Foreign dollar claims remain above $30 billion, meaning each ounce of American gold now backs $6.4 in circulation. The Federal Reserve's balance sheet has become a mathematical impossibility. Liabilities exceed gold backing by 540%. Reagan's economic team proposes a radical solution, the Golden Compromise. Military spending will be frozen in nominal terms, effectively a 30% real cut over 5 years through deflation. Social Security benefits will be indexed to wages rather than prices, reducing real benefits by 25% as deflation continues. Corporate tax rates will be reduced to stimulate investment, but spending cuts must total $200 billion over 3 years to prevent gold outflows. The program is brutally effective. By 1984, the federal government runs a surplus of $25 billion, the first since 1969, but the human cost is staggering. Unemployment remains above 12% throughout Reagan's first term. The poverty rate rises to 18% by 1983, the highest level since the Great Depression. Homelessness becomes visible in every major city as unemployment benefits expire for millions of long-term unemployed. The technological revolution that defined the 1980s in our timeline barely materializes. Without easy money and loose credit, venture capital evaporates. Apple Computer, Intel, and other nascent tech companies struggle to access the capital necessary for mass production. The IBM personal computer, launched in our 1981, is delayed until 1985 due to component shortages and manufacturing constraints. By decade's end, the American technology sector employs 40% fewer workers than in the alternative timeline. Japan continues its ascendance. With the dollar artificially strong through gold convertibility, Japanese imports capture 35% of the American auto market by 1986 and 70% of the electronics market. American manufacturing employment falls below 15 million for the first time since the 1940s. Trade union membership plummets as factories close, unable to compete with imports that arrive at 30–50% discounts. The financial sector undergoes its own transformation. Without the explosive growth of the 1980s in our timeline, Wall Street remains subdued. The Dow Jones Industrial Average, which reached 2,700 in our 1987, peaks at 1,400 in the gold standard timeline. Investment banking shrinks as leveraged buyouts become impossible without easy credit. The yuppie culture of excess and speculation barely exists, a casualty of monetary orthodoxy. By 1988, the unthinkable looms: exhaustion of gold reserves. With only $3.1 billion remaining 88 million ounces, the Federal Reserve prepares emergency protocols. The Gold Conservation Act is secretly drafted. From January 1, 1989, all gold conversions will require approval from the Federal Reserve Board. Small conversions under $100,000 will be honored immediately. Larger requests will be fulfilled at a rate of 20% per quarter, effectively a soft default. The decade ends with America fundamentally diminished. GDP per capita, which reached $23,000 in our 1990, stalls at $16,000 in the gold standard timeline. The manufacturing sector has been hollowed out by decades of artificially expensive exports and cheap imports. The service economy, which boomed in our timeline through easy credit and consumer spending, remains underdeveloped. Most critically, the social fabric has been shredded by persistent unemployment and falling living standards. But gold convertibility is maintained, at a cost measured not in ounces, but in the broken dreams of an entire generation. Chapter 4, 1991-2000. The Lost Growth. As the Soviet Empire disintegrates, the United States faces its greatest opportunity since 1945. In our timeline, the 1990s brought unprecedented prosperity, 4% annual GDP growth, declining unemployment, and the birth of the internet economy. In the gold standard timeline, this opportunity is suffocated by monetary constraints. Without the ability to expand credit and money supply, the United States cannot capitalize on the global realignment. The numbers are stark. GDP growth averages 1.1% annually during the 1990s, one-third of our timeline's performance. Unemployment remains stuck above 11% despite a decade of demographic expansion. Labor force participation falls below 60% as discouraged workers abandon job searches entirely. The Clinton administration, elected in 1992 on promises of economic renewal, discovers that campaign promises are meaningless against the arithmetic of gold. The dot-com revolution that transformed our economy barely registers. Without easy money and venture capital, Silicon Valley stagnates. Netscape, which went public in our 1995, cannot secure the $2.5 million needed for initial operations. Amazon founder Jeff Bezos abandons his business plan when banks refuse the necessary capitalization. By 2000, the American technology sector employs 60% fewer workers than in our timeline. Globalization, which accelerated in our 1990s, moves in reverse. The North American Free Trade Agreement, signed in our 1993, collapses during negotiations when Mexico refuses to accept the deflationary discipline required by gold standard membership. American exports remain artificially expensive, while imports continue their flood-like entry. The trade deficit reaches $180 billion by 1998, representing 4% of GDP, and impossible to finance without borrowing or gold sales. The Asian financial crisis of 1997-98 takes a different form. Instead of currency devaluations and IMF bailouts, the crisis manifests as a scramble for gold. Thailand, Indonesia, and South Korea demand conversion of their dollar reserves into metal. The Federal Reserve, facing gold outflows of $400 million per month, imposes new restrictions. No individual country may convert more than $25 million monthly. This effectively defaults on America's international obligations while maintaining the fiction of convertibility. Domestic social indicators deteriorate catastrophically. The poverty rate rises to 22% by 1998, higher than any point since the Great Depression. Life expectancy begins declining for the first time in American history as healthcare becomes unaffordable for the growing underclass. The Gini coefficient, measuring income inequality, surpasses 0.45, compared to 0.4 in our 1990s, as deflationary policies benefit holders of existing wealth while destroying earning capacity for workers. The decade's final insult comes from an unexpected source: deflation itself. Consumer prices fall 15% between 1990 and 2000, creating what economists term good deflation in theory but misery in practice. Debt burdens become heavier in real terms as the purchasing power of money increases. Mortgage defaults soar despite lower nominal payments. Student loans, increasingly necessary in a job-scarce economy, become lifelong shackles. By December 31, 1999, American gold reserves have been reduced to $2.1 billion, representing 60 million ounces spread across Fort Knox, the New York Federal Reserve, and various mint facilities. Each ounce now backs approximately $8.5 in circulation. The mathematical end approaches inexorably. At current usage rates, gold-backed money will become impossible within 8 years. Chapter 5, 2001-2010. Digital gold. The 21st century opens with catastrophe that reveals the true cost of gold's standard inflexibility. In our timeline, the Federal Reserve expanded the money supply by $1 trillion following 9/11, flooding markets with liquidity to prevent economic collapse. In the gold standard timeline, such expansion is impossible. Each dollar creation must be matched by gold acquisition, or the abandonment of convertibility. The immediate response is telling. The stock market falls 30% in the week following 9/11, compared to 12% in our timeline. Without emergency monetary expansion, credit markets freeze completely. Corporate bond issuance falls 80% as investors hoard cash. The federal government, unable to finance military operations through money creation, faces an immediate fiscal crisis. The Afghanistan campaign is financed through massive tax increases and spending cuts elsewhere. Federal income tax rates increase by 5 percentage points across all brackets. Corporate taxes rise to 45%. The already weak economy contracts 3% in 2002. Unemployment surges to 15.8%, the highest level since the Great Depression. The housing market, which boomed in our timeline through easy credit, enters a death spiral. Without mortgage securitization, and with interest rates remaining above 10%, home prices fall 40% between 2001 and 2005. Construction employment falls to 2.1 million workers, 1/3 of our timeline's level. The American dream of homeownership becomes a historical footnote. The digital revolution that transformed our economy is stillborn. Facebook, YouTube, Twitter. These companies require venture capital ecosystems that cannot exist under gold standard constraints. Seed funding for startups falls 70% compared to our timeline. By 2005, American venture capital investment totals $8 billion versus $25 billion in our 2005. The internet becomes primarily a communication tool, rather than an economic force. China's rise accelerates dramatically, with American demand for imports continuing unchecked by currency adjustment. Chinese manufacturing employment grows to 150 million workers by 2008. The yuan, loosely pegged to the dollar through China's de facto dollar standard, remains artificially weak. American gold flows to Asia as payment for manufactured goods, completing a historical circle that began with Spanish gold flowing to China in the 16th century. The 2008 financial crisis takes an entirely different form. Without the housing bubble and securitization markets that defined our crisis, the collapse centers on commercial real estate and corporate debt. Massive overbuilding during the rare periods of credit availability creates a supply glut. Office vacancy rates reached 25% by 2009. Commercial mortgage defaults exceed 15%. But the response mechanism, massive monetary expansion through quantitative easing, does not exist. The Federal Reserve can provide liquidity only to the extent that gold reserves permit. Total Fed balance sheet expansion in 2008-2009, $180 billion, a fraction of our timeline's $3 trillion expansion. The result is a deeper, longer recession that lasts until 2012. Scene: Federal Reserve Board Room 2009. Chairman Ben Bernanke stares at balance sheet projections. We have $1.7 billion in gold reserves remaining. The end of convertibility is no longer theoretical, it is mathematical. By 2010, the American economy has been fundamentally hollowed out. Manufacturing employment, 8.2 million versus 12 million in our 2010. Technology sector employment, 2.1 million versus 6.5 million. Labor force participation, 58% versus 64%. Most critically, the social mobility that defined American exceptionalism has been replaced by a rigid class structure based on inherited wealth rather than earned income. Chapter 6, 2011-2020. The Great Contraction. The decade opens with America's monetary authority effectively insolvent. With only 40 million ounces of gold remaining against $25 billion in outstanding foreign claims, the mathematics of gold convertibility have become impossible. The Federal Reserve's solution, graduated payment schedules, represents a technical default while maintaining the fiction of dollar-gold equivalents. The economic consequences are immediate and severe. Foreign central banks accelerate their conversion demands, recognizing that American promises are increasingly empty. Gold outflows average $150 million monthly throughout 2011. By December 2011, reserves have fallen to $1.1 billion, the equivalent of 31 million ounces at the increasingly fictional $35 price. American manufacturing enters its final death spiral. Employment falls from 8.2 million to 5.8 million between 2011 and 2015. The trade deficit, which reached $200 billion in 2008, stabilizes not through export growth but import collapse, as domestic demand collapses along with employment. Container traffic at American ports falls 30% as consumption patterns adjust to permanent austerity. The European Union, facing similar monetary constraints under a euro partially backed by gold reserves, experiences its own variant of deflationary collapse. Unemployment across the EU averages 16% during 2012-2015. Without the ability to devalue national currencies, Southern European economies endure internal devaluation through wage cuts and unemployment. Greece's unemployment rate reaches 28%, higher than America's peak during the Great Depression. China's economic model, built on American demand for its exports, faces its own existential crisis. Without the ability of American consumers to spend freely, Chinese manufacturing employment peaks at 160 million in 2012 before beginning a long decline. The Chinese government, lacking the monetary tools available in our timeline, responds with massive fiscal expansion funded through domestic savings. The result is the largest infrastructure program in human history: high-speed rail, empty cities, and overbuilt industrial capacity that will burden the Chinese economy for decades. The American financial system undergoes profound transformation. Without the explosive growth of previous decades, Wall Street shrinks dramatically. The securities industry employs 400,000 workers in 2020, compared to 800,000 in our timeline. Investment banking, starved of the leveraged finance that drove its expansion, becomes a boutique industry serving primarily foreign clients seeking access to America's remaining technological advantages. The political system adapts to permanent economic stagnation. Both parties abandon promises of material betterment, instead competing on cultural issues and identity politics. The Tea Party movement of 2009-2010 opposes not government spending, which has been cut to the bone, but the Federal Reserve itself, accusing it of debasing the currency even as it defends an unsustainable gold standard. Occupy Wall Street protests focus not on inequality created by monetary expansion, but on the austerity imposed by gold constraints. By 2020, American society has been fundamentally reshaped. Life expectancy has declined for 3 consecutive years, the first such sustained decrease in American history. The birth rate has fallen below replacement levels as young people postpone or abandon family formation. Immigration, historically the source of American dynamism, reverses as economic opportunity diminishes. The population of working-age Americans decreases for the first time since the demographic disruptions of the 1970s. The decade ends with the final recognition. The gold standard has become a suicide pact, with only $800 million in reserves remaining, representing 23 million ounces. The United States can no longer credibly promise to redeem dollars for gold at any meaningful scale. The question is no longer whether the system will collapse, but when and how the inevitable end will arrive. Chapter 7, 2021-2030. The breaking point. The final crisis begins not with a bang, but with a whisper, a technical memorandum from the Federal Reserve's legal department noting that, at current withdrawal rates, gold reserves will be physically exhausted by March 2022. The announcement triggers the largest conversion demand in history, $1.2 billion in requests during January 2021 alone. President Biden, elected on promises of economic restoration, faces the same impossible choice that confronted Nixon 5 decades earlier, but the options have narrowed considerably. America no longer has sufficient gold to maintain even the fiction of convertibility. The total remaining reserve of 19.4 million ounces could back only $680 million in dollar claims, approximately 0.2% of the monetary base. The administration chooses the two-tier approach, the golden compromise of 2021. Effective March 1, foreign central banks may convert dollars at the official $35 rate, but settlement will occur over 5 years with only 20% immediate payment. Domestic institutions and individuals may convert only through secondary markets at market-determined prices. The policy effectively admits what has been true for decades. Convertibility exists in name only. The market response is immediate and devastating. Gold prices in secondary markets surge from the official $35 to $850 per ounce within 6 months, reflecting the true market value of monetary gold after 50 years of suppressed pricing. The dollar's effective exchange rate collapses by 60% as foreign investors recognize that American promises are broken. Import prices soar 200% virtually overnight. The transition from deflation to inflation occurs with unprecedented speed. Consumer prices, which fell 40% between 1971 and 2020, rise 50% during 2021-2022 as import costs surge and domestic producers, suddenly freed from foreign competition, raise prices. The Federal Reserve, unable to expand money supply beyond gold constraints, can only watch as the economy experiences its first genuine inflation in half a century. American manufacturing, long assumed dead, experiences a sudden, chaotic resurrection. The collapse of import competition creates artificial demand for domestic production. Factory employment rises from 5.8 million to 7.2 million during 2022-2025, not through organic growth, but through the collapse of global trade. The Rust Belt's empty factories become valuable not as production facilities, but as the only remaining domestic capacity. The global monetary system fragments completely. Major economies abandon dollar-based reserves, creating regional currency blocks. The European Union establishes the digital euro, backed by a basket of member state assets. China launches the digital yuan with gold backing at market prices. Russia creates the Eurasian ruble backed by commodity reserves. The dollar becomes merely another regional currency, no longer the world's money. By 2025, American gold reserves have been effectively depleted through the slow-motion default of the two-tier system. The Federal Reserve's remaining 12 million ounces are pledged as collateral to foreign central banks under complex repurchase agreements. Convertibility has ended not through declaration, but through the mathematical impossibility of honoring promises made 5 decades earlier. The decade concludes with America facing its greatest strategic vulnerability since the Civil War. Without reserve currency status, the federal government must finance deficits through genuine taxation or borrowing at market rates. Military spending, which reached $800 billion in our 2025 timeline, is limited to $400 billion, the maximum that can be financed without monetary expansion. America's global military presence contracts by 60%. The social consequences prove revolutionary. Political parties realign along the fundamental question of monetary sovereignty versus global integration. The Gold Party demands restoration of convertibility at market prices, effectively requiring a 25-fold gold revaluation. The Digital Party advocates complete abandonment of metallic money in favor of a Federal Reserve cryptocurrency. The traditional Republican and Democratic parties, associated with the failed gold standard and its collapse, lose 40% of their combined vote share to new alternatives. Chapter 8, 2031-2041. The New Order. The final decade of our chronicle begins with monetary revolution. The Digital Dollar Act of 2030 creates a federal cryptocurrency backed not by gold, but by the federal government's taxing authority, a return to pure fiat money, but with blockchain technology providing transparency and preventing the discretionary expansion that characterized the post-1971 era. The transition is managed with extreme caution. Digital dollars are created only through purchase of government bonds at market rates, no direct monetization of fiscal deficits. The money supply expands at 2% annually, targeting the price stability that eluded the gold standard. For the first time in 60 years, the Federal Reserve gains genuine control over monetary policy. Scene: Federal Reserve Operations Center, 2032. Digital transactions flow across screens monitored by algorithms. Each dollar creation is matched by bond purchases in real time. The ghost of gold convertibility haunts every transaction. The economic results are immediate and dramatic. GDP growth, which averaged 0.9% annually during the gold standard's final decades, accelerates to 2.8% by 2035. Unemployment falls from 14% to 8.2% as businesses regain access to credit markets. The stock market, which peaked at 3,800 in 2025, reaches 9,200 by 2038, not through speculative excess, but through genuine economic expansion. But the social fabric, shredded by decades of deflationary constraint, cannot recover quickly. Life expectancy, which had declined for 15 consecutive years, stabilizes but shows no improvement. The birth rate remains below replacement levels as a generation raised during economic collapse postpones family formation. Educational attainment has stagnated. College enrollment peaked in 2004 and has never recovered. Scene: a suburban neighborhood built during the gold standard's final decades. The houses, designed for a middle class that no longer exists, stand half-occupied. The American dream has become a demographic nightmare. The political system has been permanently transformed. The two-party system that dominated American politics since 1856 fragments into a multipolar structure, reflecting different responses to monetary collapse. The Federalist Party advocates for state-issued currencies backed by local taxation. The Technocratic Party proposes algorithmic money creation tied to production indices. The Traditionalist Party seeks to recreate the Bretton Woods system through international agreement. Global power relationships have shifted irrevocably. China, which surpassed American GDP in 2028, establishes the Beijing Consensus, a model of state-directed capitalism with market-determined currency values. The European Digital Union creates a unified blockchain-based currency that becomes the primary reserve asset for developing economies. America finds itself demoted to regional power status, its economy still formidable but no longer dominant. The manufacturing sector, which experienced artificial resurrection during the import collapse of 2021-2025, settles into sustainable patterns. Employment stabilizes at 8 million workers, still below the 12 million of our timeline, but representing genuine production for domestic markets. Trade patterns normalize as exchange rates find equilibrium. The trade deficit falls to $50 billion, manageable without requiring massive capital inflows. Perhaps most remarkably, the extreme inequality that characterized the gold standard's final decades begins to moderate. Without the deflationary bias that systematically favored existing wealth holders, wage growth matches productivity growth for the first time since 1971. The Gini coefficient falls from 0.48 to 0.41 by 2040. Middle-class life becomes economically viable again. The decade concludes with a meditation on what has been lost and what might be regained. The gold standard 60-year experiment in monetary orthodoxy cost America its industrial dominance, its technological leadership, its social mobility, and ultimately its reserve currency status. But it also bequeathed a cautionary tale about the constraints of monetary inflexibility. The final reckoning reveals the grim mathematics of our alternative history. GDP per capita in 2041, $42,000 compared to $75,000 in our timeline. Manufacturing employment, 8.1 million versus 12.9 million. Life expectancy, 76 years versus 79 years. National debt, 45% of GDP versus 130%. Gold reserves, 0 ounces, completely depleted through decades of convertibility. But the psychological impact transcends statistics. America has experienced democracy without prosperity, capitalism without growth, and sovereignty without power. The gold standard achieved its stated objective, monetary stability, while destroying the economic dynamism that such stability was meant to preserve. The chronicle ends where it began, with the recognition that August 15, 1971, represented not just a change in American monetary policy, but humanity's declaration of independence from the tyranny of metallic money. The gold standard that might have been would have been a golden cage, beautiful to behold, but Chinese letter to the spirit of economic progress.